Well, happy to be here late and to be with you all again. Thanks for the great introduction. Yeah, it was funny yesterday realizing that, in fact, the last time I had been on the stage was the last trip that I took before the pandemic. So
Yeah.
nothing's changed since then. No, I'm
It's all the
kidding.
same. It's all the
It's
same.
all exactly the same, exactly the same. So,
Well,
look,
that's
what I'm
great.
going to do today is take you through a few details from our forecasts, some of the trends that we're monitoring when it comes to the Canadian economy, as well as the housing market, in a way that's hopefully informative for you as you think about the next 12 months to 2 years and your investments. I've put down a few points here. I think you'll have access to these slides afterwards. There's really three things to take away from today. The first is that rates are going to be very important. Interest rates are going to be very important. The accumulated increases that we've seen so far in borrowing costs, we think will cause a slowdown in the first half of this year. But then we think that as the Bank of Canada lowers interest rates, we'll get a rebound both in the economy and in the housing market across Canada. The second thing I'll highlight is population growth. We are dealing with all the implications of that, positive and negative. That was a big story last year. We expect it to continue to be a story, both for the economy and for housing into 2024 and beyond. So watch that closely. And then the third thing I'll focus on is affordability. We think there will be some improvements with respect to affordability in the next few quarters, but we don't anticipate that we'll be returning to where we were before the pandemic. And that's something you need to be mindful of as investors going forward. The first thing that I'll tell you is that monetary policy is forward looking. When the central bank makes a decision to raise or to lower interest rates, they're not just thinking about how things are going right now, they're thinking about how things will go, how the economy will react 6 to 8 quarters from now. Generally, when we talk about the peak impact of an interest rate decision, it occurs between 6 to 8 quarters after the interest rate decision is made. So what that means is that while people who are renewing their mortgages, people who are highly indebted have clearly felt the pain of higher interest rates over the last year and a half or so, we aren't yet at the point where the entire economy has felt the full impacts of that. We haven't felt everything slow down to the full extent. We've started to see the impacts of those interest rate hikes that occurred at the beginning of 2022, but the more aggressive ones that took place in the summer of 2022 haven't fully worked their way through the economy. So for that reason, we're expecting that there will be a slowdown in economic growth. We might tip into a mild recession in terms of growth being negative for a couple of quarters, but we do see a slowdown ahead just as those interest rate impacts work their way through the economy. Now, that being said, normally we would have expected by this point to have seen a little bit more of a slowdown. And one of the reasons that we haven't is that population growth has been very, very strong. Just the rate at which we are adding bodies to the Canadian economy is contributing to economic growth, and it's contributing to demand in the housing market. If we look at the last few quarters, the intent to buy, the intent of renters to get into the property market, into ownership, has increased significantly across the Canadian economy, but it's been particularly strong among newcomers. So that would include immigrants and temporary foreign workers and international students. So when you have population growth at the fastest rate it's been in 70 years or so, that creates a lot of economic growth and a lot of housing demand, as we'll talk about more. So as I said, we think that there will be a slowdown in the economy. We think that there will be far fewer jobs created in the next year than we've seen in recent years. We think the unemployment rate will pick up, but it won't be as significant a slowdown, as painful an economic downturn as we've experienced in the past. Think, for instance, COVID or the global financial crisis, 2008, 2009, the 1990s recession. These were far more significant economic events in terms of the jobs lost and the loss of output across the economy. We're not expecting that to happen. Part of the reason is that we think population growth will support overall economic activity. Another reason is that we're coming into this period with a labor market that's very tight. There's still a lot of positions that aren't being filled. There is more demand for labor than there is supply. So what we think is that as we go through this period where interest rates bite, the decisions made by firms will be less to lay people off, but more to just not fill some of those open positions, thereby resulting in fewer jobs lost and less of an increase in the unemployment rate than we've experienced in past downturns. So, looking at the provinces, looking at the different parts of Canada, really our outlook comes down to the exposure to interest rates. On the one hand, we have provinces like Ontario and BC. Housing plays an outsized role in their economies. So, when the housing market is experiencing a transition period, the economy tends not to experience as strong growth. Those places are also where we find the most indebted households, the folks who are most impacted by higher interest rates. And so we think that in the next couple of quarters, those are the places in Canada that will experience the most significant economic slowdowns. On the other end of the spectrum, we have places like Alberta, Saskatchewan, Newfoundland, and Labrador, where not only is there less exposure to interest rates, far less indebtedness, the housing market is doing better there, but they're getting support from commodity production and high prices as well. Those are the green dots down at the bottom. Turning to inflation, we think that this economic weakness that we're about to experience in to a greater degree will contribute to prices coming down more significantly, and that that'll eventually get us back towards where we want to be in inflation, which is about 2% by the end of this year. We got some good news in yesterday's data print with inflation coming down across most categories. This is good news for the Bank of Canada as it thinks about where it needs to put interest rates. So with that, we think that the Bank of Canada will move to cut for the first time towards the middle of this year. Our current call is in June of 2024. And what we think the motivation there will just be that at that point, it will become increasingly clear that inflation has cooled, that the economy has weakened, and so it's not necessary to keep interest rates in as restrictive territory as they have been recently. That's when we'll start to see them coming down from 5%. That's the overnight rate. And we think that bond rates and mortgage rates will follow those rates as well. Now, lower rates will bring relief for homeowners, but they won't bring us back to where we were before the pandemic. What I've presented here is just some work done by the Bank of Canada looking at mortgage payments over time under different scenarios, different structures, variable, fixed, different lengths of mortgage rates. I think the clear takeaway here is that mortgage payments are likely going up for most people. And as we get into towards 2025, 2026, there will be a very large share of people who are paying higher mortgage payments than they were at the end of 2022. Really, this reflects the fact that we are not expecting the Bank of Canada to go back down towards a policy rate around 1% or 0.5%. We think those days are over. We will go from 5% to say 2.5 or 2 over the next few years, but we're not going back to those rock bottom rates that created such stimulative conditions for the housing market where mortgages were cheap and house prices went up significantly. So that's just kind of a structural factor going forward. In terms of the market itself, this is the Canadian market. There are some regional differences, but broadly speaking, what we're expecting is that the first half of this year will be roughly flat, some ups and downs, as that economic weakness filters through and impacts housing demand. So sales and prices won't gain as much as they have in the past. But then once interest rates start to come down, once the Bank of Canada moves to bring us into less restricted territory, that's when we'll start seeing the rebound. So the second half of this year, we think we'll see more momentum in the housing market across Canada, and that'll carry into 2025, when gains become more significant. To start this year, Ontario cities are looking less likely to have some of the strongest gains. In contrast, for instance, to Alberta, where conditions are far more in favor of sellers coming into this. In Alberta, home sales are actually above where they were in 2019 still, even after the impacts of higher rates. We're looking at more balanced conditions in Ontario, both in Toronto and in the surrounding areas, just to start off this year. So we don't see a lot of scope for big price gains, at least in the next 6 months. That's what the sales to listings ratio tells us. So there's perhaps fewer positive prospects in the next little bit for those cities, particularly as we think about some of the challenges that the Ontario economy may be feeling in the next few quarters, particularly relative to other parts of Canada. The better news for property values within Toronto and in the surrounding areas is that there's sensitivity to interest rates. So we think that once the cuts begin in earnest, then we'll really start to see the bounce back that's stronger in those parts of the country. So we've seen this in just in the last year, when the Bank of Canada clearly indicated that it was pausing its tightening campaign. Toronto and other cities in Ontario saw particularly strong rebounds in home sales. When they resumed tightening, when they resumed raising interest rates, the weakness was more pronounced in those same centers. So we think that in the first part of this year, the outlook is not quite as strong for Toronto and for surrounding cities. But as we progress into 2024 and into 2025 with that better rate profile, then we'll see the stronger gains. I wanted to talk a bit about affordability as well. We have a product called the Desjardins Affordability Index. It looks at where household incomes are relative to the income required to qualify for a mortgage. It incorporates a bunch of different things, from prices to interest rates to incomes. And we wanted to kind of look at different factors that impact affordability. The main takeaway here is that even if there were a more severe recession, something more akin to what we saw in the 90s or in the global financial crisis, there wouldn't necessarily be a huge improvement in affordability. A lot of people, particularly of my generation, kind of think, oh, well, we just need a recession and then it'll be easy for me to afford a home. It's not quite that simple. On the one hand, weaker economic activity likely means weaker growth in prices, but it also means less income to purchase homes. Interest rates coming down mean that mortgage carrying costs are lower, but they also put upward pressure on house prices. So all these counteracting forces, in a recession, we could see an improvement in affordability, but it wouldn't be that significant, particularly over the next 2 years. So for you as property owners, I think this carries a few implications. There's really two I would highlight. One is that you're probably not going to lose a significant amount of the value of your asset. The conditions are just not there, particularly not in the next few years. But the other thing here, I think, is that affordability is really on the minds of people who are looking to buy as well as rent. It's become more and more of a political issue. So it's more and more at the forefront. People are looking for bargains. And with these constraints in place to returning to affordability, that's likely to remain the case. So your asset value looks relatively strong, but there are going to be concerns on the part of prospective buyers and prospective renters going forward. And that's not going away anytime soon. The final thing I wanted to talk about is just about sort of the longer term. Our view is that the way that we restore affordability is by building more. That's pretty clear. Our housing stock has not kept up with population growth. It's not just the number of people, it's also the kinds of housing that are now desired by the population. So we need to be building more. We need policymakers to be building more. That's the only solution to affordability. But this is something that will take time. When we simulate what would happen to the market if housing starts, so new construction picked up significantly, it takes a few years before we really experience a significant pickup in new listings in properties available for purchase. So it's a longer term prospect, and that's really where the discussion needs to be. We need to stop having political leaders and business leaders pointing fingers at each other. This is something that requires all levels of government to come together to build more. That's the only way we can sustain the health of our housing and construction sectors while also finding an affordable place for people to live. Finish up where I started, the three main points. Interest rates are really the important piece of the economic outlook going forward. The accumulated weight of higher interest rates we think will cause a slowdown in the economy in the next few quarters. But then as we experience those cuts, then there will be a rebound that carries into 2025 in our base case forecast. Again, watch population growth very closely. This is stimulating housing demand. We've had the fastest rate of growth in over 60 years in 2023. So this is going to be, whether that continues or whether it slows, that's going to be very important for the housing market and for the Canadian economy. And then finally, affordability isn't likely to return to pre-pandemic levels within the next couple of years. So that's something to be mindful of as a property owner and as someone who may be looking to sell or may be looking to rent in the next few years.
That's great.
We'll stop there. I am happy to take any questions.
That's awesome. Thank you so much, Marc. Fantastic. Great job as always. I'm going to put out the red meat right now because I love the question Brent Mills asked, which is, how likely do you feel is that various levels of government can actually come together to work on the issue of affordability from your perspective, of course?
Well, I think there's been a lot of progress on that front. We have been encouraged by the fact that this is such a focus from cities, from provinces, from the federal government now is getting involved, which is probably a good thing. So these are measures that will take time to have effect, and as I said, it's not going to happen right away. Certainly there's more that can be done. We've done a lot of work on this, recognizing the credentials of skilled newcomers who can contribute to the construction sector, help build more. We can repurpose commercial buildings that aren't being used towards residential buildings. So there are things to be done. I mean, certainly this is a huge challenge. We need to, we're behind the curve. We need to build more. I don't know if I want to be making predictions about politicians of different parties working together, but
we clearly love predictions here. We love predictions.
But I guess what I would say is that it's going to be challenging, but we're encouraged by the early signs. We also acknowledge that more needs to be done.
Now, Marc, what you said, there's been some early signs. There's been some progress. You've liked some of the things you've seen. Can you kind of point to something specific that you've been encouraged by that you think has had a meaningful impact, just from your perspective? Again, we're just bantering here.
Yeah, sure. Well, I think the removal of the goods and sales tax, the GST on new rental construction, that was a good move. We were actually pushing for that pretty hard. I think a lot of economists and policy people were. We like the loans that the federal government offered on new rental construction as well. These are good things. Again, these are new, so it will take time for the effects to be fully felt, but those were positive steps in our view. A few provinces have had housing supply action plans put in place, particularly focused on rental, and I think that's been positive as well. Again, we're talking about something that maybe was announced 3-4 years ago. Construction has started on some of these projects, so it will take time for us to really reap the benefits of this. But various things have been put in place. Reducing zoning restrictions in some parts of BC, the focus on increasing density around transit stations in Ontario. There's lots of these different measures, and over time we think they will have benefits.
Yeah, that's awesome. I think I like where you're going with it, and I guess I'm curious to see. I think some of the, I'm curious to your thoughts, but some of these moves, which I agree have been quite good and in the right direction, they've kind of been hampered with the interest rates. They've kind of been capped. They've kind of been restricted. Their effects have not been fully felt because of the high interest rates. Do you agree, Mark, that they'll be so much kind of more felt across the economy when interest rates come back down? Do you think that's the case?
Yeah, well, I mean, there's no question that higher interest rates are impacting building activity. I think that's been very clear. Not quite as clear in Ontario and BC. I think we were talking about this yesterday, actually. Just housing starts were resilient in Ontario, BC last year because there was a lot of activity that had been financed before interest rates went up. So there was some projects coming online. So that'll probably slow. But there's no question. There's no question that high interest rates are impacting builders' ability to build, and that's been hurting it. I think the goal with some of these measures is to try and sort of shift the equilibrium, increase the amount that we can build under normal conditions. In the situation we're dealing with now, what's happening is we're trying to control inflation, and the Bank of Canada is doing that. Interest rates are one of the most effective tools to do that, one of the most powerful tools. It causes a lot of pain. That's been difficult. But over time, as rates come back towards the normal rate, and as some of these measures start to bear fruit, then conditions will be more positive for building.
Yeah, okay, excellent. That's great. Patrick?
Well, I was just thinking, Mark, we touched a little bit on oil prices yesterday, and I think that where I don't necessarily align is that I don't think interest rates, as much as of an impact that they're going to have on certain aspects of what the economy, the impact on the economy, oil to me is still what's driving inflation, when we look at what's going on in the world. And, right now oil's in that $78 to $80 range. When you're looking at it and kind of on your research, do you have any kind of view forward? I think oil is going to go higher. That's my view. Do you have any from your perspective on what you think oil is going to do, given what's happening in the world?
Yeah, well, our forecast is that we'll have oil WTI in the low 80s for the next couple of years. There are some of these risks around the economy slowing, but there are supply constraints as well. The U.S. shale patch hasn't bounced back and started producing to the same level that it was before the last price correction. So, there's still sort of like there are shortages, and that's putting upward pressure on prices. So we sort of see $80, low $80 as our base case. Under that situation, we wouldn't expect to see as much of a contribution to the headline inflation rate from oil, just because, let's say we're going from 75 to 80. That's a far smaller percentage increase than at the start of this inflation cycle, where we were going from 70 to 120 or 130 or whatever it was. So there's less of a contribution there. Certainly, if we do see some kind of oil price spike, geopolitical tensions, supply chain issues, that could contribute to inflation and to inflation expectations to the extent that people think it's going to persist. But the goal of interest rates really is to try and tamp down those expectations. And, if oil prices rise, but the rest of the economy is slowing, that's a different kind of consideration for people as they're thinking about where prices will go. And that'll ultimately bring prices back down towards more normal levels.
Well, I think from an investor point of view, JG and everybody, is that when we look at it from a real estate point of view, here's a fundamental. We're working and operating in a kind of a high rate environment today, considered high rate environment today. We know and believe strongly that rates will start to moderate, slowly come down. In the meantime, as investors, I think it's important as investors that we don't buy into the headlines that are speaking to front-facing retail buyers, home buyers, and we can have all the compassion and the empathy in the world for there. But at the end of the day, what we're doing is being rental housing providers. We're looking and saying, okay, in the business of investing in real estate, does that still make sense? And as much as it's really challenging to get cash flow in certain regions, and there's no denying that, there's still opportunity there, because what we do have is a growing need for rental housing, and we can be that supply, if you will, of that. So we have to stay committed to it, and I guess I just want to kind of, because it's easy to get lost in these when we talk to an economist like you, it's easy to get lost in the numbers and forget what we are here and why we are even doing this work, which is to say, how do we grow our portfolio? How do we create a financial future? And we believe that real estate's one aspect of what we want to put into our portfolio, and that there is a way to do that. So when I look at it, and when we're having somebody like you on, I think we have to sometimes get out of the retail environment that home buyers live in, and look at it from a business perspective. And I think that's sometimes challenging to do, but I think it's necessary. So when we're talking about inflation up, inflation down, it really comes home to to say what are we trying to do? Stay ahead of inflation, which we know will continue. It's actually worked in. They tell you that. I mean, it's really clear. That's the government's job, is to manage inflation, keep it at 2%. That's their goal. They're telling you in advance. And so that means that assets like real estate will continue to grow with it. That's my view of it. Don't know if you as an economist look at it differently, from an investor point of view versus a retail general public point of view, or if you even have a comment on that. I don't know that there's a question in it. It's more an observation.
Yeah, well, I guess, ultimately you're trying to figure out where might interest rates go.
Mhm.
And that's going to have varying implications for different people, depending on whether you own or whether you're trying to rent, or whether you are just a person with a lot of household debt. It can be very painful. There's no question about that. But, ultimately we're trying to figure out where interest rates might go. We're trying to, as economists, to give you guidance on what to watch. I would say that if oil prices were to spike, that would have implications for inflation in the short run. Clearly, gasoline prices would be higher, energy would be higher. The question is, how does the Bank of Canada respond to that? Normally, when there's a commodity price shock, you look through it and you say, well, this is probably going to be temporary. We need to look at the fundamentals of the economy, where are demand and supply going, and what impact will that have on prices? Where it starts to become tricky, and this is sort of what happened in late 2021, early 2022, is where the spike in prices becomes a self-fulfilling prophecy. People see the increase in oil prices and they say, oh, well, inflation is here to stay. And that's kind of what happened before. There were a few factors contributing to it. So normally, if there's some kind of short run increase, the Bank of Canada might just look through that and stay on track. If they see it as contributing to higher expectations for inflation, that's when you could see rates remaining higher or being increased to try and control that. That's the way I look at it. I mean, obviously it impacts everybody differently, and I don't have a comprehensive view on that, but as an economist trying to give you a sense of how we look at this and what we'll be figuring into the decisions, that's what'll be important.
That's great. Thanks, Mark. I got a great question here, which is, based on your economic opinion, will the low debt, low housing dependency like Saskatchewan, Alberta, will they outperform price-wise in the next 5 years? What this person considers medium term. Do you think those provinces will outperform?
I would say that's a possibility, certainly. When we look at Alberta in particular, just the rate of population growth they've been seeing, over 4% for the last several quarters. One of the things that we're observing is that a lot of young people are moving there because the affordability is so much better than it is in Toronto or Vancouver. And we see that as something that could persist for the next few years. It's not like in past cycles where there was an oil price boom, people move there, oil goes back down, people leave. This is something far more fundamental, where telework is enabling people to work remote, buy and live in somewhere that's a little bit cheaper. And then we've got all these millennials coming into prime home buying age. So there could be some persistence there in Alberta and in Saskatchewan to a lesser extent. Alberta has really been the big beneficiary of that effect. What I would say is that if we look at the supply shortages, those are more significant in places like Ontario and BC. So they're kind of coming from farther behind. They're playing from further behind. And, so that's something that'll contribute to prices there, even if the economy and the demand side of the market is probably going to be stronger in Alberta for the next couple of years.
Gosh, Patrick's going to start calling you Mr. Alberta if you keep this up, Mark.
Hey, listen, be agnostic. We just go where it makes sense. I think there's a fundamental here, though, that we have to consider in all of that. When you consider that the cost of living in Alberta is lower, salaries are higher, you've got population growth, you've got great jobs, and you've got, relatively speaking, a far less expensive house or accommodation in Alberta in most cities. Well, let's just use Edmonton and Calgary as an example, the two major cities. Even when you look at Grand Prairie, Fort McMurray, Lethbridge, I mean, there's a lot of room to run in terms of getting, when you look at, for example, what's happening in Ontario or British Columbia relative to wages and salaries, it's off the charts. And so I look at Alberta, I look at Calgary, Edmonton, and even based on that fundamental kind of differential that you got in house prices versus wage growth, I mean, Alberta's got a long way to run in terms of price growth, appreciation growth, for sure. I would look at it that way. That's how I do look at it.
Yeah, but that's certainly not to discount Ontario, right? I mean, Toronto is the biggest. It's the biggest city in Canada. It's one of the most vibrant. It's a vibrant, cosmopolitan, international city. There's always going to be demand to live there, and it's more challenging to build more in Toronto than it is in, say, Calgary, where there are fewer land constraints. They can really build out and increase the sprawl more significantly.
Yeah.
So I mean, I think the fundamentals are strong for Alberta right now. The demand side's good, but there are a lot of opportunities elsewhere as well.
Oh, for
Marc,
sure.
You can't just say that to Mr. Alberta here. You're just putting taking the wind out of his sense.
Settle down.
So a couple more questions I'm seeing in the chat. One that was sent to me directly. I don't know if you can answer this one, Marc, but it's an interesting question, which is, in your opinion, what is the relationship between 100-point interest rate drop, so 100 basis points, and the price of properties in the GTA? Have you guys ever modeled that in terms of like an interest rate drop to price appreciation in the GTA?
Well, I'm actually working on a piece now that I'm hoping to release in the next few weeks or maybe in the next month or so. I wouldn't want to give you false precision on that at this stage, but certainly I would say that there's a good amount of sensitivity, and probably there's more in a place like Toronto, where there is high household indebtedness and more investor activity than other places. You probably see more sensitivity to interest rates than elsewhere in Canada.
So, Marc, when you do publish that piece, you'll send it to us so we can pass on.
Absolutely.
Yes.
Beautiful. That's great. Brent, another very astute question from Brent. He's a bit of a Picasso himself, which is how likely is that the Canadian rate policy will vary significantly from that of the US in the next 12 months? And there's obviously a lot of people have come out with research and data and nonstop kind of comparisons to the US. We don't really have any sovereignty here in Canada. We just follow the US as a lot of people are thinking. But from an interest rate perspective, what's your opinion on that, Marc?
Well, generally, we're expecting both countries to reduce rates over the next year. Economic slowdown, inflation coming down. There is obviously a correlation. The two economies are interrelated. So there is a strong relationship. Where we would say that this time's a little bit different, what might cause the Bank of Canada to deviate is around the sensitivity to housing. The level of household indebtedness, the pressure that's putting on households, the eventual more significant economic impact from higher rates in Canada versus the US. We think that's something that puts the Bank of Canada in a position to perhaps lower rates earlier, even if the US isn't quite there yet, just because there is that greater level of sensitivity. Thinking about its own inflation objectives, more slowdown in the Canadian economy might prompt an earlier reduction.
Earlier reduction. Interesting. Now, I have an interesting question here that came in, which is, you talked about how you figured, Marc, that in the back half of this year, starting halfway through the year in the back half, that's where interest rate cuts are going to start happening. And I think you framed it as, our current position is the following. Now, just curiously, how has your position changed? Obviously, and this is no dig, like everyone's position has changed quite a bit as rates went up and rates stayed higher for longer than we thought, and so on and so forth. But how has your position changed in the last little bit from that perspective. Your current position is halfway through the back half of 2024. How was that different, say, 6 months ago?
Yeah, no, that's a great question. I would say that one of the things that I mentioned it at the start, just one of the reasons that the economy has performed more strongly than we expected was the population growth. We weren't expecting that we'd be at a 65 or 75 or 70-year high in population growth at the end of this year. And so that's helped to offset, at least at the headline level and GDP growth, that's helped to offset some of the weakness. Now, if you look at GDP per capita, it's been weakening for several quarters now. So there is clearly a soft patch being undergone in the Canadian economy. But that was a major factor that's led us to revise our forecasts higher. I think on the housing front, we're looking at a few things. One is that the early data are suggesting that the first quarter of this year is coming in a fair bit stronger than a lot of people are forecasting. The employment numbers were good. The population numbers were good. So there's just a little bit more strength to start this year than we were expecting. And that's something that could alter just the timing of when the slowdown might occur this year. And that would ultimately filter through into the housing market, because the housing market forecast is based on the fundamentals. The other thing we're looking at is the extent to which bond rates start to come down in anticipation of future cuts. So there's a possibility that, rather than the really strong rebound occurring later in the year, people might front run it a little bit. It might happen a little bit earlier, something like that. So it's just something we're watching very closely.
Yeah, that's great. I appreciate that honesty. It seems like, Patrick, a bit of a recurring theme where, it's been the case throughout 2023 where everybody thought, oh, the first part of 2023, we're going to fall off a cliff. And then it was the second part. And then it was the fourth quarter. And now we're essentially saying the same thing about 2024. It's like, oh, it's coming in stronger than expected. And this just continues to happen. It's fascinating to see where it's going to go. I have two more questions because I asked these questions yesterday of you, Marc, and that was for the West Coast. And I have to ask them again. I often ask for Patrick predictions. Tonight, I'm asking for Marc Desormeaux predictions, which is, in Q3 of 2023, GDP was negative for a hot minute there, and then they revised up and they went to positive. And Q2 was negative. Then they revised it up to positive. Then Q3 came out negative. And now we're waiting on Q4, which is supposed to come out February 29th. Where do you think Q4 2023 comes out in terms of GDP? Are we going to officially enter a recession from your perspective? Where do you think we're at?
That's not our take. We think if there is that 2 consecutive quarters, it'll probably be this year. I'd have to double check our latest tracking. We actually track it in all our reports. We put out, what is this? We have a jobs number. What does this mean for GDP? Housing picks up. What does this mean for GDP? I believe we're in sort of modest positive territory. So not quite a recession, but still, overall weakening in the economy.
I love it. I love a good showdown because Patrick on Rein It In earlier this week, we just shot Rein It In yesterday. Patrick's prediction was 0 to slightly negative. Yours is 0 to slightly positive. So unless we come in at 0 right on, somebody's going to be right and somebody's going to be wrong. I'm excited, Patrick.
I think, and Marc, you don't need to voice an opinion here, but I think there's some risk here of some stagflation, and I think that is a real risk in my world, anyways, when I look at the numbers. But anyways, that's a total side note. Just putting it out there, Marc.
Yeah, well, I mean, different than what we experienced in the past, right? We don't have the same kind of inflation that was experienced in the 90s or the 80s, and we're still churning out growth so far. But I think could inflation persist for a little bit longer? There's a few factors that might contribute to that. The green transition, for instance, an aging population. All of these are things that can contribute to higher inflation, and then we've also got just weakening growth coming from a few different factors. Again, the aging population and poor productivity gains. So I mean, I think there's some truth to that. I had a counterpart at another organization talk about nouveau stagflation recently. I kind of liked that because it incorporates elements of what we've seen in the past, but it's also different this time. So I think it depends really how you define it, but not a return to the kinds of things we saw in the 70s, 80s, and 90s.
Mm-hmm.
Last question, folks, if you have any other questions, put it in the chat. Otherwise, this is the last question for you, Mark, which is, you did your forecast. Thank you very much on GDP. We have you, we'll report back very soon. Next week, we're going to find out who's right, who's wrong. But what do you think is going to go down for interest rate? March 6th, I believe, is when the Bank of Canada is calling their next interest rate. Where do you think it goes from here?
Well, our base case is that we see the first cut in the second quarter, so it'll be later than March 6th. I think the Bank of Canada, we had good news on inflation. That'll be taken as a positive sign, but we don't think that the bank will cut in March, for instance.
Perfect. That's great. You just squashed everyone's hopes and dreams here on that note. But it was good nonetheless. Ladies and gentlemen, give it up for Marc Desormeaux. Marc, fantastic, great job. Thank you so much for coming tonight. We appreciate it.
Yeah, thanks again for having me.
Appreciate your time, Marc. Really, really appreciate it. Thanks for doing that.
Take care.
That's awesome, folks. Put it in the chat. Thank Marc for his time, efforts, energy, and fantastic presentation and candid debate, candid conversation. Patrick, it's not often you get the economist from Desjardins talk, having these conversations. It's great.
It's great. It's awesome. Yeah.
That's really cool. That's
Take
awesome.
care. Thanks again for having me. Thank you.
Cheers,
all.
Marc.